Breaking. 58.6 million ounces of silver just vanished. And the Hormuz crisis accelerating that disappearance is not playing out the way Western markets expected. On March 1st, first notice day, 10,126 contracts stood for delivery. That equals 52.63 million ounces of physical silver demand. At the same time, Brent crude surged 50% in just 10 days. And silver? It sat at $84, quiet, coiled, sitting on top of what may be the most severe COMEX delivery strain in modern history. John OG sees one thing clearly. This is not normal. 52.63 million ounces demanded in a single day from registered vaults that held just 86 million ounces. Then add another 6 million ounces, drained steadily at roughly 785,000 ounces per day. No pause. Not for war, not for margin hikes, not for a 31% paper price crash in January. That silver is gone. Not theoretical, not future risk. Gone. Pulled from COMEX vaults into the hands of manufacturers, industrial users, and institutions choosing physical certainty over paper exposure. And the Hormuz crisis? It is not replacing supply. It is cutting off the roots that would have. Before we go further, subscribe now and turn on notifications. John OG goes to primary data, no noise, no recycled narratives. And when you finish, answer this. Is this a squeeze in progress or already completed? Now let's break down the 58.6 million ounce vanishing act. In 1 week in January, 33.45 million ounces were withdrawn. That's roughly 26% of COMEX registered inventory, gone in 7 days. Silver ran 150% in 2025, topped at $121 in January 2026, then crashed 46% to $64 in 2 weeks. Now it's back near the mid-80s and climbing. That volatility is not a healthy market. That is a market under structural stress. John OG calls it what it is, a system being tested. Registered silver dropped from 167.7 million ounces in October 2025 to 103.5 million ounces by February 2026, a 38% collapse in just over 3 months. The drain rate now sits near 785,000 ounces per day. If even 25% of contracts stand for delivery in March, demand pushes past 100 million ounces. That exceeds what was available at the start of the cycle. This is the math. Demand, supply. 2 outcomes only. Deliver the metal and drain inventories toward zero-force cash settlement and expose the paper system. Now layer in the Hormuz crisis. This is where everything accelerates. The impact range? 33 to 70 million ounces. From a single geopolitical event, that alone equals up to the entire projected 2026 silver deficit. John OG perspective. This is not additive pressure. This is structural shock. The strait is not fully closed, it is selectively restricted. Certain countries pass, others are blocked. This is not chaos, it is controlled disruption. And that creates 5 critical pressure channels. Channel 1, safe haven demand turning permanent. Buyers are not trading fear, they are removing supply. Every bar pulled is one less available later. Channel 2, oil-driven cost explosion. Higher energy costs raise mining expenses. At the exact moment the world needs more supply, production becomes harder to justify. Channel 3, market fragmentation. Silver is no longer one global market. It is splitting into regions. Asia, North America, Europe, each competing for limited supply. Physical premiums in key hubs are running 10% or higher above paper prices. That gap? That's reality versus illusion. Channel 4, the cumulative deficit. Since 2021, the market has been in deficit every year. Total shortfall, roughly 800 million ounces, nearly a full year of global production. This current 58.6 million ounce drain is not the beginning. It is another withdrawal from an already empty account. Channel 5, AI infrastructure demand. Data centers, semiconductors, EVs, solar, every system requires silver. Demand is not slowing, it is accelerating into 2030 and beyond. Now the counter-argument, silver may be overextended. After hitting $121, it formed resistance around $90, $92. Institutions took profits. The dollar strengthened, paper prices stalled. So we now have 2 realities. Paper market, weak, pressured, controlled. Physical market, tight, rising, constrained. Both exist at the same time. John OG conclusion, divergence is the signal. Watch 4 things next. COMEX warehouse reports. Is the drain accelerating? Regional premiums. Are they widening further? Hormuz developments. Does selective passage expand? Open interest? Does delivery demand rebuild? Because the numbers are clear. 800 million ounce deficit since 2021, 10% plus. Physical premiums in key regions, 58.6 million ounces just removed 33.70 million more at risk from geopolitical disruption. This is not a normal cycle. This is structural pressure building inside the system. Breaking. 58.6 million ounces of silver just vanished. The Hormuz crisis is not ending, it is evolving. The physical market is pricing reality above paper, and the number on your screen is still the paper price.